business school and law school. So have loved and have a high degree of affection for the Triad area. So it's a little bit like coming home, albeit virtually, through this. Justin, I saw you work. You mentioned you work at Morgan Stanley. We do a lot of work with Morgan Stanley. I don't know if you know Eric Gassrud and Tommy Shealy,
Are they on the investing side for acquisitions, or?
No, Eric's on the real estate investment banking side and Tommy's on the lending side. So Tommy's JP Morgan is one of the, we have a credit facility and JP Morgan is one of our banking. And so Eric works with us on, securities transactions, financing transactions, bond offerings, that kind of stuff, and M&A transactions if we had it. And then Tommy's involved when we want to do something in the credit market.
Okay, yeah. I think I know where Tommy is. So Tommy's I was on the large loan team for commercial real estate lending. So I think he's on the conduit side.
Okay.
And then Eric, I'm new to the banking team, but I recognize the name, so I'm sure I'll come into contact. I have to let him know that I know you.
Yeah. Oh no! Don't tell him you know me. That might not go too well. All right. So I think I understand what your group is doing. I think it's great, learning as many different ways to invest in real estate. REITs are, a different animal than what I think a lot of you may be familiar with in terms of the way that you have invested in real estate traditionally. By the way, REITs, REIT, stands for Real Estate Investment Trust. I'm going to answer well-versed to that question. By the way, I need to impress my boss. He wouldn't like it if I said I wasn't well-versed in it. Let me just start with why you would invest in REITs and just kind of frame how that's different from investing in other types of real estate assets. By the way, I don't like to do PowerPoint presentations, so I hope you'll forgive me. I just like to speak off the cuff and not share a PowerPoint presentation. The first thing about investing in REITs is the liquidity that you get by investing in REITs. And what I mean by that is real estate investment trusts are, for the most part, publicly traded companies. They're traded on the New York Stock Exchange or NASDAQ or somewhere else. And the liquidity aspect of it means if you want to get it in today and you want to get out tomorrow, you can. Obviously, one of the problems and or opportunities of owning real estate is these are generally very illiquid assets. It's not something that you can, Steve had even mentioned some assets that he has for sale, that it's going to take him some time to list it, to find a buyer, to go through the due diligence, sign a contract and all that before there's actually, he can exit his investment and then go somewhere else. One of the benefits of REITs is you can buy and sell on a moment's notice. And if you want your money back, you can always get it back. So that's one benefit to it. Obviously, there's a lot of restrictions that come with that. The second one is REITs are generally larger investment vehicles. I'll go over some of the requirements of being a REIT, but there are a lot of formalities. Most are public companies. You got to get audits. You got to do tax work. It can be expensive. There's a lot of rules to comply with. And because of that, it often doesn't make sense for real estate owners to own real estate through a REIT vehicle unless it's a substantial amount of assets. Usually you're talking about $200 million before anyone would think it would be worthwhile to form yourself as a REIT. And again, we'll get into that in just a minute. As a public company, you have a lot more transparency into REIT financials than you do privately owned real estate. Highway, for example, we file earnings releases every quarter. You can look up every address that we own. You can find out the revenue and the operating expenses of every asset that we own. You can see our customers. You can see what rent they pay. You can see the interest rate on our debt. You can see how much debt we have. You can see when it matures. There's an enormous amount of information out there about REITs. So there's, a transparency aspect that a lot of investors who invest in REITs, like to have. And then the final piece of it, comes with the dividend. REITs are generally known as dividend-paying stocks. There's a reason for that because of how we're formed and what our requirements are that I'll get into in just a minute. But we are very much like a utility. Utilities, if you invest in utilities, you do so primarily because of the quarterly dividend. So if you invest in Duke Energy here in North Carolina, if you invest in any different kind of utility, the primary reason you invest in utilities, you'd like for the utility stock price to go up, obviously, but utilities don't move very much up or down in terms of their stock price because not a whole lot changes. There's demand for electricity tomorrow. There'll be demand for it yesterday, and there's just not a whole lot of reasons that the stock price of a utility will go up dramatically, but they do pay a very consistent dividend. So a lot of older people who are on fixed incomes like to invest in utilities, and the same, attractiveness to REITs would be that, regular payment of those dividends. So, our stock price does move up and down with, the winds of the market. But generally, people get probably 60% of their return, their total return, in the form of the dividend that we pay quarterly, not necessarily any appreciation in our stock price. So, a lot of you who invest in, short-term buying and selling real estate, 100% of it's going to come from appreciation of your real estate for the most part. I mean, you might own it, you might rent it for a little bit, make a little income off of it, and then flip it. But in the privately held real estate world, I would say that more times than not, most of the profit that you earn from real estate investing is in the appreciation of the asset, whether it's an office building or a house or a shopping center. REITs are a little bit different. The reason REITs were formed in the first place is, the vast majority of real estate in this country is still owned to this day in what I would call private investment vehicles. It can be held in the name of an individual. It can be held in the name of a privately held LLC. It can be held by private equity funds. It can be held by, a whole host of different, animals, but most real estate is held privately. So unless you're a professional real estate investor, like a lot of you on here, a lot of the rest of us don't have access to investing in real estate because we don't want to go through the blood, sweat, and tears of actually doing what most of you have done, which is to actually go out and find a street address, do all the due diligence, do the hard work, figure out how you're going to finance it, acquire it, operate it, renovate it, sell it, and make a profit. Most Americans aren't good at that and don't want to do that. And so what's their alternative? Well, until the REIT concept was created, it was really non-existent, in that mom and pops around the country who wanted to invest in real estate didn't really have a way to do that unless they really wanted to do what you guys are doing. So in 1960, President Eisenhower and Congress enacted the first REIT legislation in this country. Again, real estate investment trusts. The main thing about a REIT is you avoid double taxation. That's obviously the goal of I've found in my history of working with real estate investors is very few of us like to pay tax. And when you do pay tax, you want it to be in capital gains rather than ordinary income tax. And God forbid, if you do have to pay tax, you certainly don't want to do it twice, which most corporations in America are taxed twice at the corporate level. And then after they pay out their earnings to their shareholders, the shareholders have to pay tax again. So if you have, $100 worth of rents and you have $80 worth of expenses and you have $20 left over, if you're a regular C Corp in this country, you're going to pay tax at the corporate rate on $20 of corporate income. And so your $20 goes down to $16. And then if you want to pay what's remaining, that $16 out to your shareholders have to pay tax on it again. And that's what's referred to as double taxation. REITs don't have to pay corporate level income tax. And that's principally because one of the requirements of being a REIT is that you pay out all of your earnings. So in our case, if we have $100 worth of rents, $80 worth of expenses, $20 left over, we are required to pay out that $20 to our investors. So at the end of the day, we have zero left over. So that's the benefit. REITs for the first 25 years of their history, from 1960 until the mid-1990s, didn't do any. Nobody formed them. No one thought that was a cool way to do it. The primary reason was until the Tax Reform Act of 1986, there was a lot of different ways to hold real estate in tax-advantaged, tax-sheltered partnerships and different kinds of things, where there was no real benefit for the owner and the investor to own it that way. And opening it up to the mom and pops they didn't need to do that because they could find capital 1,000 different ways. In 1986, the Tax Reform Act that President Reagan signed got rid of a lot of that stuff. And one of the few remaining investment vehicles was REITs. And then REITs really exploded in the mid-90s after the S&L crisis. For those of you who were investing in real estate in the late 80s, early 90s, there was very little forming of any kind until around 94, 95. And then in the mid-90s, you had what was basically the creation of the modern REIT industry and an explosion of publicly traded REITs, including my company, Highwoods, all over the country. Today, there are 87 million Americans who invest in REITs in one form or the other. You may invest in REITs and not even necessarily know it through your 401k. You may invest in your 401k. You may have a mutual fund that you have selected, and that mutual fund might invest in Highwoods Properties, Inc., for example. Fidelity and Vanguard and BlackRock are our three largest shareholders. The vast majority of that is owned through people's 401k. So a lot of mom and pops do invest in REITs. They just do it indirectly through their mutual funds. And then a lot of people do buy and sell, individual REIT stocks. Today, there's about $3 trillion in market value held by real estate investment trusts. That sounds like a lot, and it is a lot, but it's still less than 20% of all real estate, in the United States. A lot of the trophy office buildings and shopping centers, large apartment buildings, large industrial facilities tend to be owned by REITs, but the vast majority of real estate in this country still ends up owning, in privately held forms. There are two types of REITs. One is what's called an equity REIT. The other is what's called a mortgage REIT. Equity REITs are, and I don't know why they call them equity REITs. I guess it's because they own the equity in the real estate itself. So like Highwoods is an equity real estate investment trust. We own fee simple title to 27 million square feet of office buildings. And so we are a direct owner of real estate. Mortgage REITs are, and I think Carrie may have mentioned that she lends money to real estate investments. She could be a mortgage REIT if she wanted to go through the brain damage of doing that. That mortgage REITs are real estate investment trusts who get the benefit of not having to pay tax, but their assets are primarily mortgages that they lend out to other people to buy real estate. And then you have a few that are hybrids of both that own some. There's a office REIT based in New York that owns about 75% of their assets through fee simple title to street addresses and about 25%, in the form of mortgages. So there are, a hybrid of different ones. But what I'm mostly focused on is the equity REIT, which are REITs like Highwoods, and most REITs are, what we would refer to as equity REITs. Just a little bit about some of the formalities of being a REIT, and this is one of the reasons why a lot of you probably would never want to, even if you grew your portfolios even more. There's a lot of requirements to this that kind of your key to becoming a REIT means you can and can't do certain things. One is you have to have at least 100 shareholders to be a REIT. So if you want to control your own destiny and be the primary decision maker for your real estate, whether it's buying, selling, financing, leasing, renovating, and you don't want to have to ask other people's permission, you probably don't want to be a REIT. You want to stay a privately held company. You also, nobody can own more than 10% of an individual REIT stock. So if you had 100 shareholders, but 99 of them own 1%, and then, or 99 own 0.1%, and then you had some big guy own the remaining, whatever that is, it's high math. You can't do that because nobody's allowed to have more than 10% of stock. So it does tend to be kind of for widely held real estate investments. There are also a lot of limitations to what REITs can do. One of them, and just hearing what you guys were talking about beforehand, and I think the biggest one is that REITs are designed for long-term holds. There is a specific rule that prohibits REITs from making any profit by buying and selling real estate within 2 years. REITs are not intended to be traders in real estate. We all kind of tweak our portfolio over time, but we don't make our money on the flip. We make our money on the long-term hold. We make our money in the long-term appreciation and the long-term income off of that. In fact, it's so severe that if Highwoods was to buy a building for $100 and sell it a year later for $140, we would have to take that $40 of tax. We would have to take that $40 of gain and write a check for $40 over the United States Treasury. So it's specifically prohibited. And so when you are a REIT, there are very strict operational limits to what you can and can't do. Now I want to get into the distribution requirement, because again, that is, do REITs pay capital gains tax on the sale of a property? The answer is no, so long as they distribute out the gain from that transaction. So that gets me to this distribution requirement. So let's say in Highwoods' case, my mathematical example earlier, let's say we have $100 of rents, we have $80 of expenses, we have $20 of profit left over, income. As long as we pay that $20 out to our shareholders in the form of a dividend, we don't have to pay any tax. And that would be ordinary income tax. let's say in the same year, we also sold a building that we bought for $80. We sold it for $100, and we have $20 worth of capital gain. And let's assume it's long-term, because long-term capital gain. So we have $20 of what would normal people would capital gains income. We would not, the REIT would not pay tax on that either, so long as we dividend that out. Now, the individual shareholders, when they get that, will have to pay tax if they're not tax exempt. So there's a whole host of other issues when you're a shareholder, but a lot of people who invest in us, the 401ks and pension funds and others, don't pay tax at all. The fact that we have to pay out all of our money in the form of a dividend leads to a very real systemic challenge that all REITs have, which is that we are unable by law to retain capital to reinvest it into the business. So just to state an easy example, and then I'll go to one of your examples as a secondary example. Apple makes a whole shit ton of income every single year, and they use that money to reinvest it into the business to develop the iPhone 12 or the iPhone 20, whatever the next iPhone is. They don't have to go out to individual investors, pass the hat, raise capital, go to banks, ask Justin for money. They generate enough income where they can invest it into the business. General Motors does the same thing whenever they make a profit, although that's probably not a good example. They don't make a lot of profit. A lot of you have the same situation where if you're going to renovate your existing assets, you can use earnings that you've earned from those assets. Let's say you own a couple apartment buildings, you lease them up, you make some money out after 5 years. You could take that income and you can reinvest it in renovating it and getting higher rents. That's kind of the American dream, right? We REITs don't have that money left over because we had to pay it out to our investors, which is why REITs are what I call voracious users of the capital markets. We're in constant need of finding money to invest it to grow our business. If Highwoods wants to buy a building, because we can't retain our earnings, we have to go out and find capital from somebody. We have to raise it in the stock market. We have to issue bonds. We have to borrow it in the form of mortgages. So that's a constant challenge that REITs have that emanates from that, the dividend, requirement that we have. One of the things about REITs also, which is another limitation, is, and this isn't a rule, but this is a practical reality, REITs that run at more than 50% leverage are penalized in the equity markets. And what I mean by that is if you own $100 worth of assets, most of the time, if I was to invest in assets privately, most of the time I'm going to put a lot more than 50% debt on the property, right? And American dream is to invest as little equity as you possibly can, buying real estate, borrowing money from somebody else. If you can push the leverage up to, the leverage meaning the amount of debt, 65, 70, 75, 80, as high as you possibly can get away with. And then you renovate the property, you flip it, you make a profit, and then your return on equity is massive because you had very little equity in it to begin with. REITs are generally considered to be like utilities, somewhat safe investments for, older people who are relying on the dividend. And because of that, the public markets don't want REITs to take that kind of risk by having that much debt. So like Highwoods operates at about 35% debt. And that's actually not uncommon in the REIT industry. The vast majority of REITs operate under 50%. We could easily go out and borrow. We have a $600 million credit facility with a syndicate of banks that includes Morgan Stanley. We could go borrow all $600 million and go buy assets and make a fortune off of it because today's interest rates are like nothing. And if we can earn 7-8% on the real estate that we're buying, that would be beautiful, right? We'd make a ton of income off of that. But the problem for a REIT is that that would drive our leverage, the amount of our debt, much higher than people want to see it. And so our stock price would go down, even though we're theoretically earning more money. It would create a higher risk profile. So if we go into another financial crisis, if we go into another COVID situation like we had at the beginning, we might suffer from that. And the last piece of it, and then I'll open it up. I would love to open up for questions. I think we got started just a smidge late, is, back to this concept of the fact that we're a public company and we're obligated to disclose all the material things about our company. When you operate as a REIT, you're required to disclose a lot more than you really would want to. And the reason I say it is a lot of your competitors can find out, a lot of our competitors can find out about more about us than we would like them to know, in the form of what our rents are, what our interest rates are. I mean, when we are buying or selling real estate from somebody, there's no being coy about what the interest rate is that we're going to get on our debt, or how much money we're going to make off of an asset, or how much money we have historically made off of an asset we're trying to sell. And everything is just open kimono, and everything that you would need to know about that. That does create competitive real life challenges for us. I know Steve was trying to look for brokers. We have brokers in house here who lease our space, and they're constantly having a real life challenge to say, well, I know you leased this space to somebody else for $31 a square foot. Why don't I get $31 a square foot? Why are you quoting 35 to me? And that's just a very real difficulty of working for a publicly traded REIT, is you have to tell people, and that's the kind of cost of playing poker, for that. So, that's a brief overview, of what it means to be a REIT. REITs are not a panacea. I mean, meaning they're not an end all be all. I've had a lot of people who have owned real estate saying, my end goal is to buy up enough real estate and form a REIT and take it public. And when I walked them through all the problems with that, here's the benefits to it. The benefits to it is, we have the ability to raise capital far, far, far easier than anybody else in the real estate industry. REITs are set up specifically. I mean, I literally could borrow $600 million this afternoon from our group of banks. I could go out and do a bond offering. I could raise $1 billion before nightfall tonight because I'm a REIT. And that access to capital it's not guaranteed for REITs. I don't mean to suggest that, because you still are to the vagaries of the equity markets and the debt markets, but we have that access to capital. We can get it instantly. It's just a question of what that cost could be. So that's really one of the primary reasons that we do that. And we have the ability to grow then, fairly easily if that's what we, want to do, at least from financing it. Preston had a question for equity REITs, back to mortgage REITs. And I don't know exactly what the question was, but just I was on the board of a company based in Winston called Hatteras Financial, which was a mortgage REIT. We merged about 4 years ago with a larger mortgage REIT called Annaly. And what we did is we invested in residential mortgage securities, Fannies and Freddies and Ginnies and the sort. And that is a mortgage REIT. We didn't own any assets other than mortgages of, other people's homes collectively, or pools of mortgages. And in that context, mortgage REITs sometimes operate at much higher leverage because their assets are, their assets are so liquid. Equity REITs, again, are when you own fee simple title to a particular street address. So another question that Justin had, growing trends that you are seeing with REITs. REITs were flying high until about a year ago. For the most part, we were, getting late in what was probably the longest real estate cycle any of us will ever see in our lives. The real estate cycle began, according to the researchers, it began middle 2009. I would argue it didn't really start until maybe late 2010, early 2011. But it was operating in the sunshine for a long time. And you almost couldn't make a mistake at least in commercial real estate. I don't know necessarily everybody else's business on this screen, but in commercial real estate, I don't want to say it was easy, but there was a lot of when real estate assets are constantly appreciating, you can afford to make a lot of mistakes, right? So if it's 2012 and I should have spent $100 for this asset, but I overpaid and paid it and bought 110, if the asset's worth 150 10 years later, do you really care? Okay, I made $40 instead of 50. I'd rather make 50. But when you have a growing real estate market like that, positive trends, it covers up a lot of mistakes. You don't really have to be right all the time. Now we're in a clearly in the end of the prior cycle. I don't know whether this is the beginning of the end, or the end of the beginning, or where exactly we are in the next real estate cycle, but we are at a much more challenging environment as to whether or not, you got to get right now. It's times like this where you got to make your real estate decisions have to be correct, because, can anyone really say for certain that in 2 years from now, real estate is going to be worth more than it is today? I would argue back in 2014, you could say with a straight face pretty easily, real estate was probably going to be, it was going to rise in value to, in 2016 compared to 2014. But I'm not really sure you can say that now with COVID and, with where we are. And so the challenges, for REITs are the same anybody in real estate has, which is where are we in this cycle? Are we at the top and it's on the way down? If we are on the way down, how far down is it going to go? How long is it going to be down? And then you have, COVID has caused a have and have nots in, this is just a statement about commercial real estate generally, not specifically to REITs, but, early in the COVID pandemic, everybody wanted to own office buildings because everybody was paying the rent and nobody wanted to own shopping centers. No one really wanted to own, you certainly didn't want to own hotels. And you really didn't want to own shopping centers, and you were a little bit worried even about your multifamily and your apartments. But office, they're going to keep paying the rent. So early on, we were feeling really great about, our business model. But here we are 7 months later, and people aren't going back to office buildings quite like we thought they would be coming back. And so now the question is, are people going to be using as much, office space, as they were? So it's an interesting time to be, to be in, in the real estate industry. Another question was just, SPACs in the real estate space. If I understand that phrase, special purpose activity. I don't know what the C stands for. I think it used to be, I don't know what it is, but basically the concept in real estate, you would call it, and I think it's related to that. I think Justin's where you're going with that, is a concept of what we in real estate call a blind pool investment, which is, and there used to be a lot of these things called blind pool REITs, where if you think I'm really, really, really good at what I do because of my past track record, maybe I worked at prior REITs, maybe I did my own personal investing, but if I'm really, really, really good, what I'm going to do is I'm going to form a blind pool REIT, and I'm going to, has zero assets, and I'm going to go to all you guys and I'm going to raise money based on my prior track record and my management credibility. You're going to give me a bunch of money, and then I'm going to go take that money and I'm going to go buy real estate for us all. And I don't know what real estate address I'm going to buy because I don't know how much money I'm going to raise, and I don't know how much what the prices of the assets are going to be. But that's what's called a blind pool REIT, which is a little bit similar to SPACs, if I understand what SPACs are exactly, which I might not. That market, I think, has pretty much evaporated at the moment because of the uncertainty, around the future economic environment, balance sheet conditions and stuff like that. So I think that's something that is very common when the real estate cycle is blowing and going and everyone's making tons of money. It sounds like a great thing to do because real estate's going to always appreciate. But where we are right now, I think it'll be a while before you see those type of ancillary investments come back.
Great. Do you guys have any more questions for Jeff? I have a few. We're waiting on those to come in. How do you guys deal with CapEx or capital expenditures? How do you budget for that? How do you budget for reserves? How do you budget for maintenance, all that kind of stuff?
Yeah, it's a great question. So in our business, there's really two types of CapEx. One relates to tenant upfits. So if you're an office owner and you want to attract a new tenant to come in and take, a full floor bill at 25,000 square feet, and John Alspaw and Associates wants to lease that. Well, he wants nice offices and a nice conference room and a nice little Starbucks looking cafe and, all that. And that stuff costs money. So if it's $50 a square foot, that's 50 times, I don't know what that is. It's a lot of money, $750,000. So who pays for the $750,000? Well, usually the owner of the building does, right? And so I'm going to make John's company sign a long-term lease because I can't make money off of him if he's not going to stay for a long time. But that tenant CapEx is one, set of CapEx. That's hard to budget for. It's very hard to predict because we don't really know what the leasing is going to be like in the future. We don't know whether people are going to want what I call turnkey things, where John will just take the space as is and he doesn't care about any of the glorious stuff. And in exchange for that, I'll probably charge him lower rent and he doesn't have to stay as while. But it's hard to predict for that. It's hard to budget for that. I mean, we have a sense, obviously, with where we think the market's going to go. And then the other side of it is just building improvements, just your general shit that breaks, new chillers, roofs, parking lots, elevators, all that kind of stuff. That's easier to budget for. We have a whole asset management department that kind of, budgets for that kind of stuff. We have 5, 10, 30-year CapEx, plans for that kind of stuff. That stuff's pretty predictable. It runs about 40 million a year for us, at least across our entire portfolio. But then, our trick is, how do you finance that? Where do you get that money from? A lot of that can be captured as, operating expenses, and we don't have to dividend that out. But, CapEx is if I had to live my life all over again, I love working in an office, but if I had to live my life all over again, I'd work in a commercial real estate industry that does not suck CapEx quite as much as office, because, office owners are probably the highest consumers of CapEx because of that tenant thing. If you own apartment buildings, you basically just going to paint the walls and replace the carpet when a new tenant moves in, right? You're not really going to do anything else. Maybe you have to replace the microwave, you have to replace the refrigerator for 10 years, but it's not enormous amounts, and apartment owners have to replace the roof the same frequency that an office owner has to. A roof is a roof is a roof. The CapEx is a big, challenge for all commercial real estate operators, but it varies greatly based on what sector you're in.
Gotcha. Justin says, how does the market go about valuing a REIT versus a typical equity security?
It's a great question. Beats the hell out of me. No, so people have different views on what you're valued at. Are you valued at a multiple of your earnings? A lot of companies are valued at a multiple of their earnings, right? So if you're take that $100 that I had, $100 of expenses, $100 of revenues less $80 of expenses, you have $20 of annual earnings. Doesn't matter whether you're Apple, Highwoods, whatever. It's $20 of earnings. So one way that the public markets value equity is at a multiple of those earnings. Are you going to trade? If you're trading it, so if you have $20 of earnings, you got to divide it per share, but you trade at a multiple of those earnings. Let's convert it now, $20 into $20 per share. If you trade, which is ridiculously high, but if you traded a 10 multiple, 10x your earnings, your annual earnings, that means your stock, if you're $20 of earnings, $20 times 10, that should be $200, right? Your stock price would be $200 if you traded at a 10x multiple. Companies like Apple will trade at like a 30 multiple, and that's why their stock price goes crazy. And the reason they trade at such a high multiple is, number one, Apple's, their income is very, their business model is very sustainable. I mean, you have to assume Apple's going to be here today, it's going to be here tomorrow, number one. And then number two, you also think Apple's going to continue to grow. So it ain't going to be $20 next year, it's going to be 30, and then it's going to be 50, and then it's going to be 100. So you'll value those future cash flows differently. We're boring. We're commercial real estate. So, we're not going to trade as sexily as Apple. And so, our multiple at the moment is like 10, which isn't great, but that's one way to do it. The other way people value real estate's the same way you guys all value real estate. What's the breakup value of the company? What's the net asset value of the company? What's the value of the company if you broke it up, sold off all the assets, paid off the debt, what's left? And you divide it by the number of outstanding shares. That's the net asset value, which is for you the same thing as your equity in a piece of real estate. You could figure that out. It's more of a mathematical equation for Highwoods because we have a lot more street addresses, but it doesn't matter whether you have 3 street addresses, 5 or 300 like we do. It's the same thing. You add up, you take you can value our company if you want to do the work. Again, we're a REIT, and you look in our 10K, I promise you can find out any information you want on our portfolio. And this is what a lot of institutional investors do. They have sophisticated, Justin works for JP Morgan, has an investing arm, and they have all this sophisticated analysis where they can plug in all the Highwoods information, and they can run their own net asset values based on Highwoods. So we tell them everything you freaking need to know about all of our individual properties. You can put whatever cap rate on each individual street address you want. You come up with a total dollar value, gross value of the Highwoods assets. We tell you how much we have in liabilities. You pay that off. At the end of that, produces net asset value, and that's what those are. So earnings multiple, net asset value are the 2 main ways that we are valued. Net asset earnings multiple is when there are some people that invest in us that look at us like any other equity investment. Those people look at it on a multiple basis because that's what they're familiar with. And then people who specialize in investing in real estate, even including anybody on this screen, it's about it more, well, what's the value of real estate less what's the debt? That's net asset value. So you have NAV investors, you have multiple investors. It's a good question.
Good question. Yeah. Do certain REITs invest in certain special things? So like, do you guys specialize in office space, and then there's REITs that specialize in single family homes and then apartment buildings? And is it kind of like that, or do you guys invest in everything?
Yeah, it's a good question. So most REITs pick a product type and stick to that product type. So, we're an office REIT. 97% of what we own are office buildings. We have some little retail here and there that's kind of ancillary to our buildings, but it's mostly office. You can invest in a hotel REIT. You can invest in industrial REIT. You can invest in shopping center REITs. Most REITs pick a product type primarily, and then maybe geography secondarily. Then even inside the product type, you can have, like in the office, we invest primarily in Sunbelt Southeastern markets like Greensboro, Richmond, Raleigh, Charlotte, Tampa, Nashville, those kinds. You can invest in Boston properties, which is also an office REIT, but they invest only in Boston, New York, DC, and LA. There are some REITs that are geographic focused and not product focused. There's one called Washington REIT. They invest in Washington, DC and the surrounding areas only. They'll buy industrial, they'll buy multifamily, they buy hotels, they buy office, they buy single family, doesn't matter. They're experts in the Washington, DC area. So if you want exposure to the Washington, DC commercial real estate business of all types, then that's an option. But that's, I think, more the exception than the rule. Most people, and one of the good things about the stock market, right, is you can choose whatever you want to invest in. Like what we tell our investors, like, we're going to invest in office. If you want to invest in hotels, there are plenty of options for you to invest in hotels. So we're not even going to try to tell you that we're really good in that, and we think that that'll distract us from what we're good at. And we don't feel like we need to provide you with an investment option of some exposure to hotels, because there's 15 hotel REITs you could pick from. We've picked our knitting, and this is what we tell people, look, if you want an owner of office buildings in these high growth markets with this management team and this track record, this is what we do. We'd love for you to invest in us. And if that's not your gig, or you want more, you also want hotels, maybe invest a little in the office. What most people who invest in the REIT industry are people who can invest in real estate full time. They have a day job, but they want exposure to real estate. So they don't have, the kind of time and skills that most of you guys probably have in terms of that's your business. But they want some exposure to real estate. They're probably going to invest. They're going to sprinkle their money around a number of different sectors. And when I say sectors, I mean product sectors. Get a little office REIT, a little hotel, a little apartment. You can buy golf course REITs. You can buy prison REITs. You can buy timber REITs. The biggest ones are office, retail, multifamily, hotel, and industrial. But then there's probably another 5 to 10 more of kind of your exotic types. So there was one company that tried to do a REIT using docks and ports and marinas. They were going to be a marina REIT. In fact, they even went up to the IRS and tried to convince the IRS that a marina is a piece of real estate. And the IRS is like, what are you talking about? It's floating in the water. It can't be. It's not real estate. Real estate has to be on dry ground. So people will come up with any creative reason to try to be a REIT.
Well, then how do you sell a slip then? I guess
that's a good question. That's a good question. I didn't follow. They may have let them become a REIT. I don't know. Can you buy fee simple title to? I'm a lawyer. I should know this question, but I don't know if you can even buy fee simple. You can't sell a slip unless you have a right to the place where the slip is, I guess, right? So you must own. You must.
It was a license.
Yeah, you have it's a license, but you must own you must have water rights to something if you're going to propose offering a slip to somebody. Come about that. That's called some formal law. I can't remember. But riparian rights law or some weird thing.
That's interesting. So how should we think about REITs? I mean, I know we're at 1:31 and we're a minute over, but for the layman, how do you buy a REIT? and how should we think about REITs? So do we go to a stock market, and then should we think of it like diversifying our portfolio, or what do you think?
Yeah, so I think my own personal view is anybody who has an interest in commercial real estate should have some invested in a REIT. Not, I'm not saying invest 100% of your commercial real estate exposure in a REIT. I'm not saying, even if it's 10 or 15 or 20%. And the primary reason is the liquidity. It's an easy asset to get out of. You call up your broker and say, I want to buy, you can buy Highwoods, that'd be lovely. But, just use Highwoods as an example. I want to buy 100 shares of Highwoods. It's $35 a share. Here's $3,500. And then if for some reason tomorrow I want that money back because I found another real estate opportunity or my daughter's getting married, I just call my broker and say, sell the stock and I get my money back. So it's a unique way to have some exposure to commercial real estate investing in a way that looks and feels like a traditional investment that has liquidity, meaning you can get out, you can get in out constantly. You cannot. I mean, the biggest problem with owning real estate is you cannot get out of your investment without brain damage. And you also don't know what it's going to cost you to get out of that investment. You just don't. I mean, if you have a street address and you want to sell it, you put it on the market and you hope the market's going to be there for you, but just it's very hard and you can, the smarter you are at it, you can get good at it. But I mean, that's the thing. It's going to take, you need to find a ready, willing, able buyer. Well, in the stock market, there's always ready, willing, and able buyers. As I've been sitting here, our stock price has been changing as we've been speaking. For all I know, there's an investor who invested in Highwoods who probably based on something I said, dumped their whole position in Highwoods because of something stupid I said, and our stock price, went down from that. But, my view is I think just having, a little bit of exposure to that. Why else do you do it? It's diversification. The other problem with street addresses is all your eggs are in one basket. And that's probably why a lot of you, I heard some of you say, I've got more street addresses, I'm trying to, why do you want to expand your portfolio? Well, you want to expand your portfolio, more opportunity to earn income. Yes. But really you also want to expand your portfolio so you can diversify so that you don't have all your eggs in one basket. Now, having all your eggs in one basket, and when that basket pays off really well, that's a great day. So, the flip side is the opposite of diversification is concentration when times are good, which, it's just like having a good poker hand. When you got a good poker hand, you want to push all your chips to the table on that one hand. And if things work out, it's going to work out great. But if the dude over there's got a royal flush and you're four of a kind and a dog ain't hunting, all of a sudden you're out of that. So REITs are a conservative way to get some exposure to commercial real estate. But I think commercial real estate is such a great way to invest in a great professional life to get involved in. Or I say commercial because that's what I'm in, or any kind of real estate, because it's tangible assets. I've always felt, I'm a lawyer, but I also have a business, kind of background, and these are assets you can see and feel, and it's not, how do you figure out the value of Uber or, some of these, high flying investments these days? And I'm not saying you shouldn't invest in Uber either. You probably ought to have a little bit of that too. But, REITs are probably one of the more conservative ways to invest in commercial real estate. And it is a way for people to invest in, because you guys may have a different view of what I'm about to say, but REITs are managed by professional real estate people. So like Highwoods, present company excluded, has a bunch of really seasoned, smart people running this company. And so, when you invest in a REIT, you're hiring other people to look after that investment for you. So that's what we do for a living. And we get paid for it for sure. And so, if you can do it yourself, it's always better for that. But if you have a day job, but you want to do that, it's a good way to get involved in real estate without having to take the risk of really knowing what you're doing. One of the things that about real estate investors is trying to get involved in that without necessarily having developed that kind of skill and that expertise, and you taking that risk, and how do you finance it, and how do you underwrite, CapEx, and you gotta. I think it's a risky proposition, but again, it's with risk, comes the possibility of great reward as well. So it's
absolutely. Heck yeah. Well, Jeff, thank you so much for doing this. We really appreciate it. Thanks everybody for joining us today. Jeff, do you want to put anything in the chat box, any contact information or anything like that, or maybe your symbol on the exchange?
Yeah.
But for everybody that's here, if you want to save the chat box, what you can do is you can open up the chat window, And then the bottom right-hand section, there'll be a little button that has 3 dots on it. And if you click on that button, the top option is Save Chat. So you can save all the contact information, everything that we've talked about in the chat box. You can save that to your computer for later. But again, Jeff, thank you so much. Anything else you want to say real quick before we jump off here?
No, I just put my email address. If anybody wants to follow up, feedback on this conversation, don't ever, speak publicly again. I'm all, any kind of feedback, good, bad, or indifferent, is always good. But, I like speaking to groups like this, and I just wish you guys the best of luck with your investing.
Great. Thank you so much. Bye, everybody.